Silver has reached a moment where the market is no longer focused on how high prices once climbed, but on whether they can hold their ground. The zone between $70 and $75 has quietly become one of the most important areas on the silver chart, not because it represents a headline-grabbing number, but because it now sits at the center of a battle between confidence and doubt. Traders, investors, and institutions are watching closely, because what happens here may shape silver's direction in the weeks ahead. When a market repeatedly returns to the same area after a violent rally and correction, it is no longer just a price level. It becomes a test of conviction. To understand why this zone matters so much, it helps to revisit how silver arrived here. Only a short time ago, silver was trading at levels that seemed unthinkable to many market participants just months earlier. Prices accelerated rapidly, daily ranges widened, and volatility surged. Silver moved from being a relatively quiet metal into one of the most aggressive movers across global markets. That rally carried silver well beyond long-standing resistance zones, pulling in momentum traders, speculative capital, and renewed retail interest. As prices climbed, swings of several dollars in a single session became common, signaling both strong demand and growing instability beneath the surface. When the rally finally stalled, the pullback was sharp. Silver did not drift lower slowly. It snapped back, retracing a meaningful portion of its gains in a short period of time. Since then, price action has settled into a more compressed but still volatile range, with repeated tests of the $70 to $75 area. Each dip into this zone has attracted attention, and each bounce has been met with caution rather than enthusiasm. That hesitation is what makes this range so important. The market is no longer chasing upside blindly. It is evaluating whether the foundation built during the rally is strong enough to support current prices. Psychologically, the $70 to $75 area carries weight because it represents a shift from excitement to realism. During the rally, traders were focused on upside targets and breakout levels. After the correction, focus shifted to defense. Many participants who bought near the highs are now watching this zone as a line between recovery and deeper discomfort. For those who entered earlier, this range represents an area where profits shrink but do not disappear entirely. That mix of hope and fear tends to concentrate activity, making price reactions here more emotional than rational. Structurally, this zone also matters because it aligns with where momentum first accelerated during the rally. Markets often remember these areas. When price breaks above a range decisively, that same range frequently becomes important when prices return. It is not because of any inherent magic in the number, but because of how many decisions were made there in the past. Positions were built, added to, and defended in this area, and those decisions influence behavior when price revisits it. Several forces are now pressing down on silver as it tests this range. Profit-taking remains one of the most immediate. After such an aggressive rally, it is natural for traders to lock in gains, especially when volatility stays elevated. Even participants who remain positive on silver longer term may choose to reduce exposure temporarily, waiting for calmer conditions or clearer signals. That steady stream of selling does not need to be dramatic to matter. Over time, it caps rebounds and weighs on price. The futures market adds another layer of pressure. Silver is heavily traded through leveraged contracts, and leverage magnifies sensitivity to price changes. During the rally, speculative positioning increased sharply as traders used futures to gain exposure. As prices pulled back, that leverage became a vulnerability. Margin requirements rose alongside volatility, forcing some traders to reduce positions regardless of their outlook. These adjustments tend to happen around key levels, making support zones feel unstable even when selling is not driven by panic. Macro forces continue to influence silver's behavior as well. Strength in the US dollar has made commodities priced in dollars less attractive to non-US buyers. Rising bond yields have increased the appeal of assets that offer income, drawing attention away from metals that do not. Expectations around central bank policy remain fluid, with markets reacting not just to economic data, but to how that data reshapes assumptions about interest rates and liquidity. Silver sits at the crossroads of these forces, responding quickly to shifts in macro sentiment. Compared with gold, silver often struggles more during corrective phases, and this period is no exception. Gold tends to attract longer-term holders and institutional players with defensive mandates. Silver, while still a precious metal, has a stronger speculative and industrial component. That makes it more sensitive to changes in risk appetite and economic expectations. When uncertainty rises, silver can be pulled in multiple directions at once, amplifying volatility. Near key support zones, that volatility tends to increase as traders test the market's resolve. Large market participants approach this phase differently than short-term traders. Institutions and hedge funds are less focused on day-to-day fluctuations and more concerned with how price behaves over time around important areas. As silver tests the 70 to 75 zone, these players are watching volume, volatility, and the quality of rebounds. Are bounces shallow or strong? Does selling accelerate on weakness or fade quickly? The answers help them decide whether risk should be reduced further or whether conditions are stabilizing. Repeated tests of support change market behavior. The first test often attracts buyers confident that the level will hold. Subsequent tests can weaken that confidence. Each time price returns to the same zone, the market asks the same question again, but with more urgency. If support holds, it can strengthen as sellers exhaust themselves. If it fails, the move lower can be swift, as expectations reset and defensive positions unwind. This dynamic is why traders watch not just whether support is touched, but how price reacts when it is. From here, several realistic paths remain open. Silver could stabilize within this range, moving sideways as volatility gradually contracts. That kind of consolidation allows the market to absorb selling pressure and rebuild confidence without dramatic price movement. Another possibility is a break below the zone, leading to a deeper correction as traders reassess value and risk. Such a move would not necessarily invalidate silver's longer-term appeal, but it would signal that the market needs more time to reset. A third scenario involves a volatility-driven rebound where selling pressure fades and price snaps higher as short-term positions are adjusted. This type of move often happens quickly, but sustaining it requires broader support from macro conditions and sentiment. Monitoring the right signals becomes crucial in this environment. Movements in the US dollar can offer early clues about pressure or relief for silver. Shifts in interest rate expectations influence how investors weigh metals against other assets. Economic data shapes assumptions about industrial demand and inflation. Market sentiment, visible through volatility and trading behavior, reveals whether fear or confidence is gaining ground. None of these signals operate in isolation, but together they help explain why price behaves the way it does around key zones. As silver continues to trade near $70 to $75, uncertainty remains the defining feature. This range is not just a number on a chart, It represents the point where optimism from the rally meets caution from the correction. Silver has always been a market driven as much by emotion as by fundamentals, and that trait is on full display here. Whether support ultimately holds or breaks, the process itself reveals how participants respond to risk, volatility, and changing narratives. In a metal known for dramatic moves, this zone may well determine whether the next chapter begins with stabilization, deeper adjustment, or renewed turbulence.